Hey guys, welcome back to another video. My goal is that by the end of this video, you will understand what a discounted cash flow model is, how to build a discounted cash flow model, how to use a discounted cash flow model to value, for example, a company's stock or an investment project, and how to answer job interview questions about discounted cash flow models, also known as DCFs. At the end of this video, I'm also going to share with you how you can download my discounted cash flow model in Excel for totally free. So make sure you stick around for that. And also, if you're interested in a specific section of this video, I have added timestamps in the description, but I would recommend that you watch the entire video if you are new to discounted cash flow models. So DCF models are used to value something based on the future cash flows that it is expected to produce. This means that DCF models are an intrinsic valuation method compared to, for example, relative valuation that compares something to other things that are similar. For example, comparing a company to its competitors and then valuing the company based on what the competitors are worth. DCF models instead focus solely on the company and its cash flows, so it is an intrinsic method that doesn't focus on all these other things. Discounted cash flow is one of the most popular valuation methods out there and is widely used by investment firms and investment banks to value, for example, companies or company stock. But DCFs are also used by most corporate companies to value their investment projects. That is also how I use DCFs in my day-to-day work life. So I work as a financial analyst in corporate finance at a renewable energy company, where I sit on the investment team and I sit in DCF models basically all day, valuing future potential investment projects and figuring out how we can increase the value of those investment projects by using DCFs. And later in the video, I will give you an example of what a DCF for a company versus a DCF for a project can look like. So here you see the discounted cash flow model that I built for this video. As you can see, there are two different tabs down here. There's one for a company DCF and there's one for a project DCF. We will start with the company DCF and then move into the project DCF, because there are a couple smaller differences. And by the way, the reason why some of the cells are blue and some of the cells are green is because all the green cells are the input cells and all the blue cells are the cells that we don't have to edit, because they're just going to calculate things automatically depending on what you put into the green cells. So the only cells that you have to fill out in this model to use it yourself are all the different green cells. So what you want to forecast to do a discounted cash flow model is the free cash flows. And so we have a line of free cash flows down here in line 43. And the free cash flows represent the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Unlike net income, free cash flows is a measure of profitability that excludes the non-cash expenses of the income statement and includes spending on equipment and assets, often called CAPEX or capital expenses, as well as changes in working capital from the balance sheet. So basically, free cash flow is the amount of cash that is generated each year and that is free and clear of all internal and external obligations. So this means that it reflects the amount of cash that the company can safely invest or distribute to its investors, both including equity and debt investors. So once we then have our free cash flows, we discount them back to the present using a discount factor. Once we then have our discounted cash flows, we add them together with a terminal value if that's relevant. And then once we've added all of that together, we have our final valuation and we're done. And if none of that made sense to you, don't worry at all, because that was just a quick overview and we're going to go through it all step by step in more detail right now. So the first thing that we have in our discounted cash flow model is our income statement. I just made this income statement up, so all these numbers are imaginary for a fantasy company, but just to give you all an example of what it could look like. So at the top we have years, and so this model is for 10 years. And then we have our revenue at the top line, then we subtract our cost of goods sold. That gives us our gross profit. Then we subtract OPEX, operating expenses. That could be things like marketing or salaries or rent and so on. Then we get our EBITDA. Then we subtract depreciation and amortization. Depreciation is related to capital assets. So if a business, for example, buys a computer that it expects to use for 5 years, it's going to allocate the cost of that computer over 5 years. And that means that it's going to depreciate the computer over 5 years. That could be taking 20% of the cost of the computer and allocate that over 5 years. So that's depreciation, and amortization is basically the same thing, except it's for intangible assets. So if a company, for example, has a patent that's going to last for 20 years, it could amortize that patent over 20 years. And so after we subtract depreciation and amortization, we get our EBIT, our earnings before interest and taxes. Then we subtract our interest. And so here we actually have a positive value for interest. So that assumes that we have debt investors in the company. And we of course have to pay those investors interest every year. And so after we subtract interest, we can subtract taxes too. In this model, I have just assumed a generic tax rate of 30%, but you can change that up in this cell here. Then the entire model will adjust to that new number. But here we just have 30%. So we subtract 30% and then we get our net income. And we then take the net income line to find the free cash flows that we're after. So we copy this line down to this line here. As you can see, it just refers back up to this line. And so to calculate our free cash flow, we start with our net income line. You could also start with EBITDA or EBIT, but personally, I find it the most intuitive to start with net income. And also, net income tends to be the most easily retrievable line to get from, different companies. So that's just what we're going to start with. And so in this section, we are calculating free cash flow to the firm. And so that is the unlevered free cash flow. And you can also calculate the free cash flow to equity investors. And we're going to do that in a section down here very soon. But we're going to start with the free cash flow to the firm. So that means the cash flow that is available to all the investors in the company, both equity and debt investors. And so calculating this will help us get to the enterprise value, that is the valuation of the entire company, everything included. And if you then want the value of the equity, and so the stocks, for example, you can then subtract out the debt and the cash and then get to the equity valuation that way. Or you can also calculate directly the free cash flow to equity investors down here. We're going to get to that section very soon. But let's start with this one because I think this is a pretty good one to know. So starting out with free cash flow to the firm, you start out with net income like we just discussed, then you add back depreciation and amortization because depreciation and amortization are non-cash expenses and we are trying to find the cash flow, so we don't want to include anything that's not a cash expense. And so we add that back. Then we also add back the interest expense after taxes. So basically we take the interest expense up here and multiply it by 1 minus a tax rate of 30%. That gives us the interest rate after taxes. And so we add back this interest expense because this is a cash flow to the entire company, both equity and debt investors. And so we want it to be before the interest expense. After that, we subtract CAPEX. So that means new investment in equipment and other big capital assets. Like we just discussed, that can be a computer, it can be machinery, it can be like so many big things. Basically just like big investments of things that you're going to use for years in your company. And so we subtract the CAPEX because that is not already included in net income, and capital expenses is an actual cash expense, it's a cash outflow, so that's why we subtract it. Finally, we subtract the change in net working capital. So net working capital is a difference between your current assets and current liabilities. You can calculate that from the balance sheet. And we just want to subtract that because that is, again, a cash expense. And then that gives us the free cash flow to the firm that we are after. And so we have that forecasted out here for 10 years. And so now that we have all the free cash flow to the firm, all we have to do is to discount that back to the present. And the reason why we have to do that has to do with the time value of money. And so the time value of money concept says that money today is worth more than money in the future. And the reason for that is that if you have $100 today, you can use that for consumption, you can invest it and help it grow. Whereas if you don't get the $100 until, years away, you don't have the opportunity to do anything with that money in between. In addition, inflation tends to be positive, usually 2%. That's not the case this year, but inflation is usually a positive number. And so because of inflation, money also tends to be worth less in the future. And so all these different factors combined with the fact that investors do take on risk when they invest in a company, whether they invest in the debt or the equity of the company, they take on some amount of risk. And so all these factors combined mean that investors have a required rate of return. And so that is the rate of return that they want to get on their investment. And that is the rate that we want to discount our cash flows with. But how do we calculate this required rate of return? Well, so because we are looking at the free cash flow to the firm, it is a cash flow available to both debt and equity investors. And so we want to find a weighted average cost of capital that encompasses both the required rate for the debt investors as well as the required rate of return for the equity investors. And so that rate is called the WACC. The first thing we need to do to calculate the WACC is the cost of equity. And so up here, we calculate the cost of equity. And the cost of equity can be calculated in a very simple way using the CAPM formula. And that is also what is used in this Excel model. And so basically you only need 3 different inputs for the CAPM formula. you need the risk-free rate, you need the market risk premium, and you need the stock beta. And so the market risk premium is the amount of return that investors require on top of the risk-free rate to be willing to invest in the general stock market. And so here I have set that at 6%. That's a pretty reasonable number, but it depends on, what stock market you're looking at, what country you're looking at, all of that stuff. But we're using 6%. And then you multiply that by the stock beta. And the stock beta is basically how volatile your stock is compared to this general stock market. And so here we have a stock beta of 1.2. That means that our stock for this company is more volatile than the general market. So if the market goes up by 1%, our stock is going to increase by 1.2%. And if the market decreases by 1%, our stock is also going to decrease by 1.2%. So that's the stock beta. And so we multiply the market risk premium by the stock beta, and then we add the risk-free rate on top of that. And then we have our cost of equity. So in this case, that is 9%. And then we can use this to calculate the weighted average cost of capital, or the WACC. And so that is calculated right here. And this is the rate that we want to use for our free cash flow to the firm. And so the way you calculate this is basically you start by finding out what share of the company is equity investors and what share of the company is debt investors. So for example, in this case, we have 80% equity and 20% debt. So we take those 80% and multiply it by the required return on equity, which we have up here, so that's 9%, so 80% times 9%, so that's the first half of the formula. And then in the second half, we take the 20% of the company, that's debt investors, so 20% times the cost of debt, which is the interest rate, and that is 5% in this case. And so we multiply the 20% times the 5%, and then we multiply it by 1 minus the tax rate of 30%, because interest rate expenses are before tax. And then this formula altogether gives us the WACC. So that is a discount rate that we're going to use for the free cash flows to the firm. And so if we go back down here, we want to calculate our discount factor using this rate. And so in the first year here, we see that we discounted by saying 1 plus this WACC, so the required rate of return, which is 8%. So 1 plus 8%, that's 1.08. And then we raise that to the power of the period. And so this is the first period. And we raise that to the power of 1/2. And I will get back to in a second why we're raising it to the power of 1/2 instead of to the power of 1. But we raise that to the power of the period number, and then we have our discount factor. And so if you want to go out in the future, for example, to year 4 here, you can see again, we take it 1 plus the WACC, so that's 1 plus 8%, raise that to the power of the period number up here, and then we get our discount rate. And so these aren't just like 1s and 2s, it's because I removed the decimals, so you can see that they do go up every year. So the further out in the future that you go, the higher the discount factor will be. And the reason why we're not just using periods that are 1, 2, 3, 4, 5 and so on, but 1/2 and 1.5 and 2.5 and 3.5 and so on instead, is that we're using the midpoint discounting period. And this is a really good thing to know if you do work with DCFs in your job on a day-to-day basis, or especially if you are interviewing for a job where you will be asked about DCF models in that interview, because they will probably test whether or not you know about this. And so the reason why we're using these half values instead of the whole numbers is that we take a cash flow that is generated throughout the year. It's not a cash flow that's generated on the last day of every year. We expect that this company is going to, sell things and have expenses distributed throughout the entire year, not just on the final date of the year. And so because it's throughout the entire year, you don't want to discount all the cash flow from that entire year as if it was made on the final day of the year. And that's what you do if you discount by a whole number. Instead, you want to assume that on average, all these different cash flows came in the middle of the year. So half before the middle of the year and half after the middle of the year. And because of that, you want to subtract 1/2 from the intuitive period number. And so for example, take the first year here where we discount by 1/2. And so not all the cash flows were made in December. We also made money in January and February and August and so on. And so because of that, we want to make sure that all of that is discounted by, a good midpoint, which would be in the middle of the year. And that would lead us to discount it all by half a year instead of a full year. And so that's why it's at 1/2. And then the same principle applies to the entire period. And so that's why we use the midpoint discounting formula. There are very few cases where you would not want to use the midpoint discounting formula. So in general, I would apply this, especially if it's a DCF for a company. So that's a really good thing to know. But yeah, that's how we come up with our discount factor down here. And then it just continues, out in the future. And then the way we discount our cash flow is, of course, we take our cash flow up here and then we divide it by the discount factor. And we do that across the entire period. And then over here, we have the sum of all our discounted cash flows. And that's basically what we've been after this entire time. But this is not our final company valuation yet, because this is only the value that the company is going to generate over the next 10 years. But we would assume that the company is still going to be worth something at the end of the 10 years because it's probably going to continue to operate. So when you do a DCF for a company, you tend to assume that the company is a going concern, which means that it's going to operate into infinity basically, which isn't realistic, but you do expect it to operate beyond the period that you are forecasting here with the discounted cash flows. And so you want to find a terminal value too. And the terminal value is what the company is going to be worth at the end of the periods. So in our case, that is what the company is going to be worth at the end of 10 years. And to calculate the terminal value, we will use the Gordon growth formula. You could also use a relative valuation multiple, but I won't do that here since we're trying to keep it an intrinsic valuation method. So we will be using the Gordon growth formula. It also applies a lot of the similar concepts to the DCF, so it makes a lot of sense to apply it here, but you could apply either. But by applying the Gordon growth formula, this is what we do. So here we have the terminal value calculated. And what you need to calculate the terminal value, apart from the numbers that we already have right here, is a growth rate. And so I won't go into detail how you can calculate this growth rate, but oftentimes it's also just based on, like for example, the GDP growth rate of the country or something like that. But basically the growth rate is the rate that you expect the company's free cash flows to grow with every year into infinity. And so in our model, I have assumed that that is going to be 3%. And so we're going to use that 3% to then calculate our terminal value. And so the way to calculate the terminal value is that you take the free cash flow in the final year of your DCF, so that is in year 10 for us, and then you calculate that by 1 plus the growth rate, so 1.03. And then you get the free cash flow in year 11. And then you want to divide that by the required rate of return, so that is our WACC up here, minus the growth rate of 3%. So you take the year 11 free cash flow, divide that by 0.05 in our case. And then you have the terminal value in year 10. But we want the terminal value in our current year, so that's year 0. And so we have to discount that value 10 years back. And because this is actually what the company is going to be worth on the final day of year 10, we will discount it by 10 and not 9.5. And so that's what you see up here. We have 1 plus the required rate of return, the 8%, raised to the power of 10, and then that is what we divide this number by. And so that gives us the terminal value here. And then the enterprise value, which is what we're looking for, that's the company valuation, is simply just the sum of the terminal value and the discounted cash flow to the firm. So yeah, we made it. That is the final outcome of the DCF model, basically, to find the company value. And if you want to find the equity value from this, you could subtract out cash and debt from this number, and then you would have the equity value. Or you could calculate the free cash flow to equity investors, which is what we're going to do now. And that's going to be much quicker because most of it is the exact same thing as how you calculate the free cash flow to the firm. And so down here, we have the free cash flow to equity investors calculation. And so again, we start with net income to make it simple. So same line as up here. Then we again add back depreciation and amortization because that is a non-cash expense. Then we also, something new here, we add back net borrowing. So that is the amount of debt that you took out minus the amount of debt that you repaid. Because the free cash flow that we're trying to get to here is only for the equity investors and not the debt investors. And then the next thing we do is we again subtract the new CAPEX. Then we also subtract the change in net working capital, just like we did up here with the free cash flow to the firm. And then that gives us the free cash flow to equity investors. So basically the only difference between the free cash flow to equity and free cash flow to the firm is that free cash flow to equity includes the changes in the amount of debt that the company has and interest payments, whereas the free cash flow to the firm does not. And then once we have the free cash flow to equity, we do the exact same thing as we did before. We're going to discount it And so we're going to calculate our discount factor. It is calculated in the exact same way as it was for free cash flow to the firm, except this time we're using the cost of equity to discount it instead of the WACC. But again, same system with the periods. Again, we're using the mid-year discounting period. So we're using 1/2 for the first year and 1.5 for the second year and so on. And so we have our discount factors down here. Again, there are multiple decimals hiding, we just can't see them. And then to get our discounted cash flow to equity investors, we just take our free cash flow to equity and divide that by the discount factor, like we have done here. And then we get all the discounted free cash flows to equity. And then we have to sum up those out here. And then the only thing that's left is, of course, to calculate the terminal value so we can get the entire amount of equity value in the company. And so we're going to calculate the terminal value in the exact same way. It's so nice, it's all the same, guys. And so we're going to use the Gordon growth formula. Once again, we're taking the free cash flow in the final year of our DCF. So in year 10, we're going to calculate that by 1 plus the growth rate. So here I have set the growth rate to be 4%. Growth rates for free cash flow to equity are assumed to be higher than free cash flow to the firm because of the leverage effect. That's why it's higher here than it was for the free cash flow to the firm up here. But otherwise, it's the same thing. We take our cash flow, we multiply that by 1 plus the growth rate, so 1 plus 4%. And then we divide that by the difference between the required rate of return for equity minus the growth rate. So in our case, that is the 9% we have up here, minus the 4%, so that gives us 5% again. And so we divide the 5% by that value, and then we just discount it back 10 years. Again, we're using 10 here because it is the value at the end of 10 years, not in the middle of 10 years. And so we discount it back by 10 years, and then we have our terminal value in present terms. And then we just add that to the discounted cash flow to equity investors, and then we get our total equity value. And so a couple things to note is that up here we have like a little summary I made for you guys in the model. And so we have the value of debt and the market value of equity, and then we have our calculated value of the whole company, so the enterprise value, and then we have the value of the equity. And so here, for example, you can see that the calculated value of equity is actually higher than the current value of equity, so what the market values the equity at right now. And so according to this model, the equity in this company, and so the stock in this company is undervalued, so the stock would be a good buy according to this model. So that's how you can use this model for valuation purposes. Hey guys, it's editing me here. I just want to jump in and say that obviously this is not financial advice. Whether or not the investment decision that a model like this suggests would actually end up being a profitable investment decision depends on the accuracy of the many assumptions that you have to make in a DCF. And if we assume that those assumptions somehow are correct, the investment outcome still depends on the market recognizing this. And if you want to go from the enterprise value up here to the equity value, all you want to do is you want to subtract out the debt, so that's the $300 million in this case, and the amount of cash that's in the company. So I haven't written that down, but you can find that on the balance sheet. And then you get the equity value too from the free cash flow to the firm. And so all the information that you need to do a discounted cash flow model like this on a public company is available online, because public companies, at least if they're listed in the US, have to, make all this information public online. So you can just download this from the internet and do a DCF on any public company, basically. That can be a really fun exercise. But yeah, this is one of the most popular ways that hedge funds and investment banks and other investment firms value companies to decide whether or not they would be a good investment for them. And so another quick thing I want to touch upon before we move on to the project DCF is the number of years that you're going to forecast in your DCF model. And so obviously this model forecasts 10 years. For the most part, if you're doing a company DCF, you will forecast either 5 or 10 years, depending on how much detail you want to go into and how much information you have. In rare cases, you're going to forecast 15 years, but 5 or 10 years is usually the norm before you then do your terminal value estimate, and then you come up with your valuation. And when it comes to choosing between free cash flow to the firm or free cash flow to equity, which one you should calculate, it really it depends on the company. And so if you do calculate the free cash flow to equity, you want to make sure that the company is expected to have a stable amount of debt over the forecasting period, and also that the company isn't extremely levered. So that means that the company doesn't have like a huge amount of debt, because if one of those things are the case, your free cash flow to equity forecast could be pretty inaccurate. And so if one of those things are the case, you would want to calculate the free cash flow to the firm instead. But now let's move on to the project DCF. And so here we have it, and you will see that a lot of these things look exactly the same as they did in the company DCF. And that is because it's all the same underlying principles, which is really nice, because once you have learned to do one DCF, you can do all the DCFs basically, or just about, because there are so many things that are the same in all of them. And so this kind of DCF is what I work in every day. Obviously, the models that I work in are a lot more complicated than these and more detailed, but this is a really good sort of just overview of what it looks like. And also just to explain a little bit more about what I mean by an investment project. So for example, I'm a financial analyst at a renewable energy company. And so an investment project for us is an energy farm that we are considering investing in. And so in my DCF model, I forecast all the expenses that it will cost to build and to operate and to eventually tear down when the lifetime of an energy farm is going to be up, and also how much money we're going to make in the years that it is operating. And so an energy farm like that for us is going to last multiple decades. And so our DCF is going to be multiple decades long, but again, it really depends on the investment project. Some investment projects might only be 1 year long, some might be 10, some might be 100. So it really depends on the project here, how many years you want to forecast it. But the main difference between this DCF model for a project versus a DCF for a company is that with a project, you expect it to have a limited lifetime. Whereas with a company, we assumed it to be a going concern and so to operate indefinitely. But a project is going to have a finite lifetime, and you're going to be aware of that when you do the DCF. And so here we're assuming that our project is going to have a 10-year lifetime. And so basically how that changes our free cash flow calculation is that we are not going to have a terminal value calculation, because at the end of the 10 years, the project is going to end. And so there will no longer be any kind of value tied to the project, because the project is not going to exist anymore. All the value will already have been taken out of it. And so that's what this DCF model reflects. So let's start from the top with this one too. So we start with our revenue, then we subtract our cost of goods sold, then we get our gross profit, then we subtract that our operating expenses. Then we might also have abandonment expenses here if it costs money at the end of the lifetime of the project to tear it down, for example. And then we might also have expense DevEx. So DevEx is development expenses, so that's what it costs to develop. We might also have some expenses there to subtract. After all of that, we then get our EBITDA. Then we subtract depreciation and amortization that comes from our capital expenses. And then we get EBIT, then we subtract interest. Here, I have assumed that interest is just at 0. And then after you subtract that out, you then subtract the taxes out. Again, same system, we have it up here. You can just change the tax rate if you want it to be something else. That's gonna change the entire model too. But let's just put it back to 30. And then you get your net income, and then you're going to once again use your net income to calculate your free cash flow to the project. And so we're going to do the same thing that we did before. So after we have our net income here, we will add back depreciation and amortization because it is a non-cash expense. And then we're going to add back interest expense. And then we're going to subtract the CAPEX like we also did before. And then finally, we will subtract the change in net working capital. And that gives us the free cash flow for the project. And so once we have this free cash flow, we of course discount it back to the present. And so we calculate our discount factor in the same exact way like we did before. We just take 1 plus the required rate of return that's up here, and then raise that to the power of the period number. Again, we're using the mid-year discounting period because we assume the cash flows to be spread more or less equally throughout the entire year. So for year 2, we're discounting it by 1.5. And so then once we have a discount factor here, we can then use that to calculate our discounted cash flows down here, which is just the free cash flow divided by the discount factor. Then you get the discounted cash flow. And yeah, and then we have the sum of all the discounted cash flows out here. And because there's no terminal value in this project, since all the value is contained in these 10 years and there will be nothing more beyond these 10 years, we don't have a terminal value. And so that means that the discounted cash flow that you see here is the NPV of the project, or the net present value, or our valuation of what the project is worth to us. And so in this case, that is $14 million. And these $14 million in project value are also shown up here as the NPV of the project. And so when you decide whether or not to invest in a project, the first thing you want to look at is NPV. And so if NPV is positive, it means that you are going to make money from this project even after considering your required rate of return. And so you should go ahead and invest in that project. However, you can also use a measure called the IRR, that is the internal rate of return. And so the internal rate of return is basically the required rate of return where you would get NPV of 0. And so for example, here in the model, we set our required rate of return to 16% because that is what our IRR is. Our NPV right here is going to go to 0. So yeah. And so basically, if your IRR is higher than your required rate of return, you should go ahead and invest in that project. However, the IRR can behave in mysterious ways if your cash flows look a little bit different. And so the safest measure to go by is the NPV. And so your final investment decision should in general always be based on your NPV. And so if your NPV is positive, you should go ahead and do an investment because that means that you will be making money off it even after considering your required rate of return. And so the final thing I want to show in this model is that if we look at the company DCF, you can see here we just had numbers like all throughout because we are expecting this company to exist both before and after this forecasting period. Whereas in the project, the numbers here look a little bit different. There's a lot of empty cells. And basically, if you want to think about it, it's just because, the first year here, we're expecting to have some development expenses. We're not expecting to have any revenue yet. Then we're expecting to have some capital expenses in the next years that are then going to be depreciated over 5 years. So the capital expenses are down here, so you can see. And then only in year 3, we expect to start making money off of this. And this is a pretty, normal looking project. So this is usually how they're structured. You have some expenses in the beginning, and then you only start making money later on in the project. And then we have some years where we are making money, very nice. And we also have operating expenses in the years that we are making revenue. And then in the final year, we have a little bit of abandonment expenses because this is the final year where we're going to tear down our project and clean it all up. And yeah, and so that's like a pretty normal looking income statement for a project like this, just to explain the numbers a little bit better. Also, for those of you who are curious, because I know that most of the people watching my channel have come from one of the videos that I've done on the CFA exams, you will also encounter DCFs in the CFA curriculum, both for level 1, 2, and 3. Especially level 2, that is already a very quantitative level, has a ton of material on DCFs. Obviously though, the CFA exams do not cover anything in Excel, and so you won't see DCFs in a spreadsheet format. It'll more be like a simplified version, but where you really have to study all the underlying concepts and formulas and stuff. And so knowing a bit about DCFs going into the CFA exams are a very helpful thing. But yeah, that was the video. I hope you found it useful and learned a bunch of stuff about discounted cash flow models. I would love to hear your thoughts about it in the comments down below. And if you have any questions for me, feel free to ask those in the comments too, and I will do my best to respond to you as quickly as possible. And if you liked the video, make sure you like and subscribe. It makes me so happy when you do. And I will of course also make this discounted cash flow model that I've been using throughout the video available to you all for free. And so if you want your own copy of this DCF model, all you have to do is to DM me on Instagram. So I will put my handle up on the screen here. And so send me a DM on Instagram with the email that you want me to send the DCF Excel file to, and then I will send it to you as quickly as I can. And without further ado, I hope you have a great rest of your day, and I will see you in the next video. Bye guys.